Hey guys, John Paulamy here, Actionable Intelligence Alert. Today's Saturday, November 16th, 2019, and we got the weekly market update. Before I get started, just want to remind folks if you want to support the channel and you do not want to subscribe to the newsletter or become a Patreon, which you can do, links provided below. You can support us here by liking these videos, sharing these videos, and subscribing to the channel. The more people that like the channel, the more people that comment, the algorithm in YouTube presents this video to more folks that are searching for these topics. I mean, this is a pretty eclectic video channel. It's not for everyone, but I do enjoy the interaction we have because we got a lot of long-term listeners and viewers, and appreciate the comments and questions. Again, if you do want to support us, take a subscription to the newsletter or go over to Patreon and become a Patreon there. If you do become a Patreon, as a gift, we will give you the current month's stock pick from the newsletter. That's a one-time stock pick. But anyways, let's get into the weekly update. One of the things I wanted to talk about was the definition of inflation, because I think that's going to become an issue going forward, specifically because of all of the central bank actions that I have cataloged over the last month or two. There's a website that tracks central bank actions, and we've seen over 70 or 80 interest rate cuts from various central banks around the world, and it continues because of the lack of economic growth. Inflation, as far as indicated in prices, has been declining in most places. So this has given room to central bankers to increase money in circulation, and lower rates, and encourage debt and borrowing. Kind of wanted to go back to what Milton Friedman, famous economist, had as a definition of inflation. A lot of people think inflation is rising prices. Again, as we've said on many other occasions for many other topics, if you don't define your words properly, then sometimes or many times you do not know what you're talking about. Inflation is not rising prices. Inflation is an increase in the supply of money. Price rises are a manifestation of that increase in money. And you can go on YouTube. I'll put some links up there. Milton Friedman talks about that. Gives examples in some videos, old videos. He's dead now, of course, but he does talk about that as it applies to the gold rush. And we also know, what happened in Spain. When the Spanish went to the New World, i.e. Central and South America and the U.S., specifically in Mexico, they grabbed a whole bunch of gold from the conquered peoples there, gold and silver. This metal was the exchange mechanism. It was money in those days, and sent it back to Spain. And this did cause rising prices, caused inflation there. It's caused an increase in the supply of money, and prices increased. So this is actually leading somewhere. I don't want to get too far into an economics dissertation here, but what I'm suggesting to you is that we have a lot of the press who are always lagging indicators talking about economic decline, recessions, and I think that the world has already been in a recession. We've seen that from the indicators, but as always, these things end. And I think what I wanted to say here was, inflation, Friedman said inflation is always and everywhere a monetary phenomenon. If you print enough money, if you inflate the money supply, you can create economic growth as far as it's measured by increases in GDP. And that's what we've seen, these economic cycles, what they've been since we've had the creation of central banks. That's what they do. They go through various cycles of creating currency units. This is injected into the economy through the banking system, creates increases in money supply, you get economic growth, nominal growth. Of course, if you have too much debt, you just force this, you're going to get a lot of malinvestment. That's what we've seen with these historically low interest rates. You've seen all these companies like WeWork, fake meat companies, all this other nonsense, Uber, Lyft, all these things, a bunch of companies that sell a dollar for 90 cents is basically what that has engendered. And then that somehow Wall Street and people have got their heads wrapped around, well, if I sell a dollar for 90 cents and my sales are going up hundreds of percent a year, that's a good stock investment. That's malinvestment. And that's dead wood on the bottom of the forest floor that accumulates. In the short term, it feels good, but in the long terms, prices rise because as you increase economic activity, you reach the limits of what the capacity of the labor force and the supply chain they can't keep up. They can't grow as fast as the growth that you can force through injecting and increasing the money supply. So, as I've heard many times, and I actually agree with, economic growth or expansions don't necessarily have to ever end. Typically, what happens is they are murdered or they're killed by the central bank raising rates. That forces a decline in liquidity, and then that creates a knock-on effect where economic growth then begins to fall. Debts then can't be paid, and then you go through this deflationary or disinflation cycle as the debt cycle ends, and economic growth is not sufficient to support the debts that were incurred during the previous inflation. Now, you never really know what that catalyst is going to be. Like I said, typically it's a central bank raising rates. It can also be an energy crisis. And so I think that, the U.S. now is starting to slow down because of the actions of the central bank last year, and now we're cutting rates again. These things have a lag effect of up to a year to 18 months. But what I've seen is that around the world, we've seen massive amounts of money printing and interest rate cuts. So, right now the globe is not in synchronous economic growth, or the economic cycles are not they're not in synchronous speed, if you will. Their U.S.'s kind of economic growth is slowing, yet the rest of the world shows green shoots and the leading economic indicators are turning up. Now, I'm actually leading somewhere with this, because what I want to show is that I think that the catalyst for the end of this debt cycle, the thing that's going to kill this economy, the thing that's going to end up being the thing that brings an end to this debt cycle and this whole expansion, if you will be exponential increases in energy prices. So, eventually a catalyst comes along that bursts the bubble and causes massive deflation and debts. Then, of course, the central bank goes in and prints money again, buys up the debts, does whatever it has to do, and you never really clear the dead wood. You never really get rid of all of the malinvestments. You never really heal from the previous inflations. So the cycles just keep repeating, yet they get bigger and bigger and more onerous. And the other thing is they can't deliver the same level of growth. If you'll notice, if you go back and look at a chart of interest rate cuts by the Federal Reserve over the last several economic cycles, they've been getting less and less bang for their buck. They've only been able to raise rates at lower amounts during each cycle that they raise rates because there's so much debt out there and so much malinvestment that as soon as they begin raising rates, they start incurring a deflation and they have to quickly change tact and start printing again. And this is what central banks do. They rinse and repeat. They're just engines of inflation. That's all they are. So, having said that, manufacturing PMI is stabilizing globally and even looking up in some areas. That's a result of all the money printing and all of the rate cuts that are happening around the world and continue to happen. Those economies are cycling back up now as we are beginning to cycle down. You can see that, the U.S., everybody's actually, it's like I said, if you print enough money, you can get a response. You can see as of last year, if you remember, late last year when the U.S. was cutting rates and or raising rates, and then we had the mini crash, I guess, pullback in the market about 20%. Oil prices declined. It was a big mess. And then you see everybody is cutting rates, and you can see the PMIs are turning up in most areas. This is rate of change, 3-month rate of change. And manufacturing purchasing managers index momentum is stabilizing globally and looking up in some areas. And you can see that. And we've actually seen even reports from Germany and some other places that, yes, the economic prints were barely growth like 0.1, but you can see that the PMIs and the leading indicators are turning up. I thought this was an interesting chart from a chart pack that I was looking at this week. Surging semiconductor prices implies ISM manufacturing index greater than 55 next 3 months. You can see the correlation. I mean, it goes back to 2005. You know, the semiconductor index pricing of semiconductor prices has led, it appears, ISM manufacturing indexes higher. In the past, it seems to be a big difference here, so we can expect, if history is any guide, that the manufacturing indexes will be turning up and heading north into expansion again. I would say that if we do see manufacturing indexes above 55, if you remember from a previous video, that typically implies a rise in oil prices and basic material prices, which makes sense. As manufacturing expands, you will see increased materials prices. Now, I'm not suggesting this is real growth or sustainable growth. I'm just suggesting that if you print enough money, you can create nominal GDP growth and you can create malinvestment. That, you know, what is the catalyst that's going to pop that, I think is going to be, and we're going to get into that, and I've been talking about it, is the fact that energy, there's been no investment into energy, into oil and gas, nuclear, these type of things, coal, but yet they're still mainstays of the economic growth. They're our main energy sources, and people haven't been investing. You know, the zeitgeist has turned against the oil and gas industry. And we have a major Democratic nominee for president, Elizabeth Warren, saying that she's going to ban fracking in the United States if she gets elected. Again, I've said this before, I don't think she can do it, but the mere suggestion is not a positive attitude towards the oil and gas industry. We see many governments around the world, we see cities and states trying to sue the oil companies. So, you know, we've seen sovereign wealth funds like in Norway and some other places say that they don't want to invest in oil and gas anymore. And it's like, you know, I'm going to poke my eyes out because I don't like looking at the girls in bikinis at the beach. I mean, it's just not, you know, cut your nose off to spite your face type attitude. And this whole political manifestation of this climate change non-reality, in my view, around CO2 being the driver has taken hold. It doesn't matter what John Polomny says or what his views are, because I'm in the minority. You know, they've trained up an entire generation of people to believe in this, and they're going to, as millennials obtain power around the world, they're going to pursue these policy goals to their detriment. Now, these policies are not being pursued in places like Russia, China, and India, and the rest of the emerging and frontier markets, because those people are rational and understand that fossil fuels will allow them to grow. What I'm trying to suggest here is that we are seeing the beginnings of a inflationary cycle because of all the central banks. We're going to have economic growth, and what we've seen is that, you know, the energy sector weighting in the S&P is now at a historic low. Look at this. The energy sector's weight in the S&P index has hit a historic low despite the recovery in oil prices over the last 2 years. You know, the oil price is up 30% over the last year, and oil stocks are now at almost an all-time low as a percentage of the S&P 500. It's so out of favor again. And we've seen this before. We've seen this before when we've got to these levels. And what has happened in the past, we've seen massive recoveries, because regardless of what you think, the facts are that oil's not going anywhere for a long, long time. And the other facts are is we haven't been investing enough to maintain that production. As I've said before, over the last several years, for every 6 barrels we've produced, we've only found 1 replacement. And to go back to my mantra, in an extractive industry, if you do not replace your reserves, eventually you go out of business. So I would suggest to you that if you are a contrarian and you believe that fossil fuels will be a mainstay of our energy mix and that we have not invested enough, and that as a percentage of the S&P, energy stocks are at an all-time low, I think it sets up for a change in perception. No one's going to buy these. There's pension funds that will not buy energy stocks now, like in Sweden and Norway, these places. There's going to be more of this. Like I said, there's more millennials who have bought into the anthropogenic man-made climate change. They're going to continue to deny oil while still trying to benefit from it. People don't put together the facts. Greta Thunberg sails over here and will be sailing back in vessels that are built and made from the feedstocks of oil and gas. But that doesn't, people just, they don't know. They don't understand, how things are made or what the constituent properties are. That all the products that we rely on for modern civilization, plastics, dyes, pesticides, industrial scale agriculture to feed all the people, is all based on fossil fuels, and it cannot be replaced in any time soon by windmills and solar panels. It's just a not relevant. People really need to read that book I was talking about the English Industrial Revolution, as it transitioned from an organic economy based on fuel from the sun, basically how much crops you could grow for your own caloric consumption and how much fodder you could grow for your animals for their caloric fuel and consumption. That was the limits to growth. The book goes into, the reason why you had railroads and shipbuilding and industrial revolution was because coal allowed, steel making through the Bessemer process that allowed building of all the rails for the railroads and then powering it with coal and all the metal you needed for their locomotives. You could still make steel with wood as a feedstock, but you would have cut down every tree in England and not even done hardly any dent in the steel making. So I think a lot of people take a lot of things for granted, and that's our opportunity. What premise is wrong and bet against it? The premise that fossil fuels are going to go away in any time frame that's legit for investing, and I'm talking a couple decades, is not going to happen. As a percentage of overall, I'll give you an example. As a percentage of overall energy use, coal will decline, but the coal numbers will go up every year around the world, but they'll become less of the overall energy mix, but it still will grow. And people don't look at these things. They just say, well, we just need to build more windmills and solar, and then you're a Nazi if you, want to do more oil drilling. And that's our opportunity, because everybody's sold out. Everybody that's sold has sold. Okay? Everybody that wants to get out is out. Everybody that believes that EVs are the future and that's going to solve everything by buying a Tesla and using paper straws has sold their oil stocks. That's why we're at an all-time low in the S&P as a waiting for energy. And people get mad when we start talking about this stuff like politically, but it's true. You have to look at the premise that's being made. What is the reality, and is it true or false? If it's false, you've bet against it. Now, if you believe that oil is going away in the next decade, that this green revolution is going to happen, and oil's demand is going to collapse, then you certainly should not buy oil or oil service stocks. God bless you if that's what you believe. That's a view. People have it. I'm not going to argue. I'm not going to try to convince you. What I'm saying is, for the rational out there who understand the supply chain, understand how products are made, understand how energy transitions take decades and decades and decades and cost trillions of dollars, then this is an opportunity. We talked about it in the past and in the last couple of videos about how U.S. shale is slowing down. U.S. shale's never made any money. It's not cash flow positive. And now that's finally dawning. Again, it's another industry that was selling dollars for 90 cents. And it worked as long as the Wall Street people could spin it. If we drill enough wells at a loss, we'll eventually become profitable. It didn't happen. So what has happened is that because of all of the oil that was produced unprofitably, it pushed out other investment into other sources of oil, i.e. offshore. So now what you have is that lack of investments now catching up with the offshore industry. You have some major projects coming online in Norway this year and in South America and Guyana, and then you don't really have anything, and you really have topping out of production. Now, I don't like to use linear things on the upside or the downside because of this will get, this will be reflected in a higher oil price, and that will cause more investment eventually. But this is what I'm talking about. There's been lack of investment in offshore oil, and now you're going to top out, and it's going to go into decline. And unless the investment scape improves and increases offshore, they will be in decline. Remember, we get 30% of our oil from offshore, so we cannot, in the time frame of projects for offshore, this is 10 years is nothing. From 20 to 30, not 2020 to 2030, you're talking about halving the output from offshore oil. That means, 30% of our oil that we get, half of that's going to go away over the next 10 years if the investment in offshore oil doesn't increase. That will cause prices to go higher. And there's a lag to this too. You just can't snap your fingers, go out there and start drilling. And magically, a week later, you've got oil in production. These things take years. Just the engineering, the procurement, the build out, the drilling, the completion. I mean, this takes years. And the investment hasn't happened because oil's going away, because prices have been low because of the malinvestment caused in the shale basins. And that's going away now. So, you really have to be cognizant of these things. And guess what? Oil demand growth is not going away. It grows every year. I thought this was interesting too. Here, this really kind of sums it up, I think. What you're looking at is a chart of market cap on the left in trillions of dollars. And what you see is on the blue line, you see the market cap of the Apple company, your iPhone, iMacs, all that stuff. And what you're seeing in the gold is the S&P 500 energy market cap. That is all of the energy companies, all the values of all the energy companies in the S&P 500. And that enable civilization now, that's oil and gas, that's nuclear, that's coal, that's the whole shebang. All those companies in the S&P 500, those are your mainstay companies, ExxonMobil, ConocoPhillips, I mean, the whole shebang, BP, whoever else you want to look at, whoever's in the S&P, big companies, all your refining companies, Valero, all that stuff. The total market cap of those companies, if you took the value of the Apple Corporation, it's more than all of the energy companies in the S&P now. Doesn't that tell you something? We don't need iPhones to live. We don't need iBooks or iMacs or iWatches, whatever they call them. Apple makes good products. I have an iPhone sitting here. I like it. It works good. Is the company worth $1 trillion? I don't know. You can make that argument. Is it necessary for civilization? No. You can say that definitively. You make things harder, but you could go get, another type of phone. Yeah. Or we could just have flip phones, or we could just go back to dial phones. We'd still all survive quite nicely. But what you're saying here is that the market is saying that this convenience around this technology company that it creates is more valuable than all of the energy companies that trade in the S&P that give us the energy to survive and to have this modern society. I thought this is one of the most important charts, I think, that kind of stipulates and magnifies the argument that I've been making since I've been making these videos for 1.5 years. We are in a massive bear market for energy, and that's not going to last. And you either understand that or you don't. Now, the argument to me is, well, this hasn't panned out like you've said. Well, I can show you companies in Canada right now that have 20 to 25% real cash flow yields at the current oil price, and no one cares. And they're massively buying back their stock, and they can basically go private over the next 3 or 4 years if the oil price doesn't increase. And it's and no one cares about that. No one's buying those companies because, you have this negative sentiment towards energy, specifically oil and gas, and negative sentiment towards Canada because the Trudeau administration is very anti-oil and gas. Yet, you're not heating downtown Toronto right now with solar and wind. You're heating it with natural gas. So, I think you really have to look at it. It's kind of like that argument we made the other day about how tobacco stocks, one of the most hated industries, an industry that kills 400,000 people a year just in this country, has been the best performing set of stocks in the S&P 500 for decades. This is after being lionized, sued, paid hundreds of billions of dollars in fines and in settlements to states and counties when they were sued, and still are churning out cash flow. Now, I don't personally invest in tobacco stocks. I just can't get my head around it. I don't want to be involved in that. Just the same way that people of Greta Thunberg's persuasion want to divest themselves of energy stocks because they feel like that's killing the earth, and that's fine. But you don't need tobacco stocks you don't need tobacco smoking and consumption to have modern civilization. You do need energy. Energy permeates every activity and underpins every activity that we do as humans, for at least in modern society. And the question I have to ask people is, if you want to get rid of oil and gas, fine. Tell me what the replacement is. And don't just tell me that prices are going down. That's just a linear extrapolation. Where are you going to get the materials? How are you going to do the build out? How are you going to heat all of these homes and businesses and industrial facilities in the northern latitudes with electricity from solar panels? When, the sun comes up at, in the wintertime at what, 7:30, 8 o'clock, it reaches its apex at 11 or 12, and then goes down at 4. You don't even get the same amount of photons in the winter as you get in the summertime. So all these little nuances have to be discussed. You talk about batteries, they decline. You put a battery in a Tesla or any other electric car, it declines. In 10 years, 8 to 10 years, it has to be replaced. They can't be recycled right now. So the answer would be, well, we'll come up with the recycling technology. Well, I want to engage in interstellar space travel. I want to go to, out in space. It's, I'm a big Star Wars, Star Trek guy. I like all that stuff, science fiction, but I know it's not a reality in my lifetime. It just simply isn't going to happen. And it's the same thing with some of these other technologies. You have to tell me how you're going to get from the lab to commercializing the technology in sufficient quantity to dent these other technologies. Now, I have no doubt as the new cohort of voters, and millennials are bigger than even the boomer population in the U.S., as they come to power, and a lot of them have been indoctrinated since kindergarten into this, that they're going to try to implement these policies. It's going to lead to a tremendous amount of wealth redistribution to the people that live in reality and understand what's going on. I have no doubt that if Elizabeth Warren becomes president, she'll try to ban fracking one way or another. And if she's successful, the oil price goes to $85, $90 a barrel within a couple days. And then what? So I think this is where the opportunity is. Energy as a whole, obviously we like nuclear. You talk about uranium, nothing's happening there. You just have to sit and wait. It's the same thing with these other companies. I had an email from a guy he said, John, I've been listening to you and I get it, but nothing's happening and I can't just sit here. Then you got to sell because you got to wait for it to happen. And I can't tell you when it's going to happen. You can look at the businesses, go all the way back to the mouth of the python. If you want to look at a project, look at it as like a big python. The mouth is the start, and the excrement is the end product, okay, which is the actual produced oil and gas. And what are we seeing on the front end? If you go look at, there's a company in France and there's a company in Norway, you can go look them up. I'm not going to give the names because they're going to be in my newsletter, but they do offshore seismic. They own ships that go out and do the seismic activity to quantify in 3D and 4D terms where the best place to drill is for the hydrocarbons that they suspect are there. That's the first thing you need to do. And their order books are filling up. I'm not talking about, 5% growth. I'm talking about one of the companies is now profitable again, 50, 60, order books are growing 50, 60, 70% earnings growth year over year. That's the front end, the investments being made. We go back to this chart, okay? It's going to fall off. If you're going to build projects out here, 24, 26, 28, you're already doing that front end surveying right now. And we're seeing it on the front end of the Python. We're seeing more jackup rigs. We're over 80% utilization in the high-tech type jackup rigs. That's what we said would happen. The oil companies are going to move into the shallow water first because it's quicker to recycle those projects, quicker to bring them online. And then as the oil price strengthens, as they get more cash flow, they will move back into the deeper water projects. It's just not happening as quickly as people want. That's what I told the guy. The facts are there. Some of the earnings reports this week didn't look that good from a lot of from Valaris, our former Ensco friends, and maybe some of these companies will go bankrupt. But I suspect by 2021, 22, 23, when a lot of their debt comes through, I suggest to you that they're probably going to be able to get refinanced fairly easily. Because why? Because I suggest to you that 2, 3, 4 years down the road, as we've created all this money and this false economic growth is going to suck up a bunch of resources, and we haven't made the investments into oil and other basic materials. And all that money that was created through those interest rate cuts and through that money printing is going to manifest itself in higher prices in basic materials. It just happens like the sun comes up and like the sun goes down every day. It's just cyclical. Close out here because it's getting kind of long. Wanted to talk about Adam Rosenzweig. Goring and Rosenzweig had a good blog. I'll put a link to it. Talking about the same thing. He said, oil equity prices divorced from reality. By any measure, oil and oil-related securities are radically undervalued. Over the last 120 years, we estimate it took 17 barrels of oil on average to buy 1 unit of the S&P 500. Today, it requires over 53 barrels. The only time it has taken more was during the parabolic .com blow-off. Incidentally, an excellent time to become an oil investor. At the same time, energy-related equities now make up a mere 4% of the S&P 500 by weight. Not only does this represent the lowest level in at least 20 years when our records begin, it is 75% below the peak levels reached in 2008, at which point energy stocks made up 16% of the S&P 500. So a lot of people are seeing this. So it really comes down to one of two things. Are energy stocks and energy-related companies severely undervalued because they have a negative perception to them and because prices have been low or have been lower than anticipated? Or is hydrocarbon-based energy on its way out in a relatively soon time frame, like in the next 10 years, like many are suggesting, such that it's a dying industry that will no longer be needed? It's a buggy whip industry. Those are really your two choices. So you really have either a necessary industry that is severely undervalued, misunderstood, and underinvested in. That's choice one. Or it's buggy whips and it's on its way out and you'd be stupid. And that's why to invest in it, because that's why the prices are low and that's why they're going to continue to go low. That's your other choice. I can't convince you. You have to look at the facts yourself. I believe in the former. I'm heavily invested in that. As always, I cannot tell you when the exact turn is coming. Looks like fundamentally the fundamentals that many companies have turned, and if that continues, all I can tell you is that will eventually engender a sentiment change. And if nothing else, it's like Eric Nuttall at 9 Point Partners has said many times at BNN, if the companies in Canada that have these huge cash flow yields won't buy their own stock, who else will buy it? And that's what they've been doing. So I think that the worm is turning. If you look at the facts, if you look at what's really happening, Vice just, people making editorial comments. And as I said before, I believe that hydrocarbons are necessary for this civilization that we live in, and that any energy change that does happen will happen over decades. So that's it for this week, guys. I appreciate you listening. Look forward to the comments, and we'll talk to you next week. Thanks.